Hi everyone, and welcome to another episode of the HeelanHub Podcast, the show for small business owners. I'm Dan Heelan, and on today's show, I wanted to talk to you about what you can do at the start of the tax year to have the sort of set you up for the best, successful, most tax efficient year you could ever imagine. Now, I've done a few of these over the last few years, and I want to take a slight different approach to it this year. And I'm going to give you kind of a checklist or kind of an order of priorities to have a look at. Now, I wrote this order of priorities in about 10 minutes in a busy day, so hopefully they're all going to be there. But I always think the most important things come top of mind. So they're not a strict order. I think depending where you are and depending where your situation is, you could look at them and think that maybe they're a priority list in another order that I'm going to give it to you in. But that's what we're going to do. We're also going to look at it in chunks. So I'm going to look at it and say, okay, limited company owners, let's talk about you. Sole traders and partnerships, let's talk about you. And regardless of the situation, let's have a look at this kind of cohort of people. So if you want to skip some of the segments, you can. I think there's probably something in each segment for everybody. Maybe you're not a limited company yet, but you're thinking of it. So I think it's good to hear that. If you're a limited company through the sole trader bit, you might know somebody who's also a sole trader, or sometimes it's good just to understand the differences. And some of the points actually cross. So if you're watching this on our YouTube channel, the HeelanHub Podcast channel, feel free to skip forward if you want to, or obviously you can listen to it on 2x speed, maybe if you're listening to the podcast, something like that. But I'd encourage you to listen and watch it all. But if you do want to skip and save some time, that's it. I will try and keep it as short as possible. So let's get into it. Okay then, so to set you up for tax year success as a limited company owners, let's start with them. Point number one would be looking at your director's salary. So presuming you're paying yourself a salary from the company, things have changed. So from April 25, we had the disastrous budget at the back end of last year, the autumn budget, this black hole budget as it was known in the news. And they announced that there were some massive national insurance changes that also affect directors. So this year, if you're on a sort of a tax efficient salary, many of you will be on around 12.5k a year. And if you're on that kind of level, you're probably going to pay about £1,100 of national insurance, employers' national insurance. And that's quite a big bill because of the way they've changed it. They've lowered some thresholds. They've changed what is occurring. They've changed the percentage you're paying at. There's a whole big piece around this. And I don't want to spend the whole podcast talking about it because I absolutely will do another podcast talking about what's the best levels of bunny ears, what's the most common scenarios we see, when might you not declare a salary, and that will be there. I mean, if you can't wait, because this is going to be coming out to you by the time we've done this, probably last couple of days of April, you might already be wanting to declare your salary for April. If that's you, check out our main YouTube channel at Heelan Associates. There's a full guide on there that I've done, including screenshots and overlays and spreadsheets, just showing you, as much detail or not as you might want to see about the various levels. Again, because tax is very specialist to your situation, it's not going to give you every answer that you might need, but honestly, for the majority of situations, there's going to be something you can take away from that video. So go and do that. But do know that I will be releasing a podcast for sure talking about those things as well, because it's a detailed subject. So have a look at that. But review your salary level. And that's whether you're paying it already, so check your salary level, or whether you're not paying it, because there might be a reason to pay it. Particularly, I find in the startup world, people overlook this, and you could be missing out on like £3,000 worth of tax deduction, depending on where you are with it and what your situation is. So do go and check it out. You could also be losing out on state pension qualifying years. That helps to see what pension you would get from the government when you get old. So hopefully you'll live long enough to see it the way that the government keeps moving the year at which you qualify for it. But anyway, so those things are all really important. So go and review your salary. That would be my number one highest priority on the limited company. Now, second thing, it's a bit longer term. I've put it high up the priority list, and you could argue about where it is. But I think if you're looking to contribute to a pension, you should be thinking about it early. You don't have to make the payment early with a limited company, because there's a very, very tax efficient way of doing it for most people. And again, you can get this checked. But if you were looking to pay into a pension for your limited company, the most normal tax strategy would be to have the company contribute as what's known as an employer's contribution. So, like when you're employed, your employer pays a percentage on top of what you pay in. It'll be the same for you. Your employer, your company, would pay, but you wouldn't pay any. So you would just pay the company's contribution, and that's completely fine to do that. In fact, even big corporates sometimes do that with their employees. So it's entirely possible to do it. It's corporation tax deductible in most cases, so it saves a massive chunk of corporation tax. But you don't have to do it monthly. But for some people's cash flow, they like to think about it early. They like to think, I'm going to put 200 quid a month aside or whatever the case may be. So just think about early, am I going to do this? Because you might also want to factor it into just your plans. Can your business actually afford to do it? That kind of stuff. The big thing about this is wherever you decide to make it, we're talking about it in the tax year now from sort of 6th of April to the 5th of April 26. But it's really important if you want to impact your next tax bill for your company to pay it before the financial year end of your limited company. So you kind of got these two things in play. You've got personal pension limits that are tax year to tax year, and then you got the company's financial year end, and you want to make a contribution before that if your goal is to reduce that corporation tax bill. So that's why I put it quite high, because for all I know, your company year end is the 30th of April 25, and you need to be making it in the next couple of days to impact that tax bill. So put it in there. But it's a big win. It really is. If, and that's the golden question that I, as a mere accountant, because I'm not financially regulated in that sense, it's in the realm of financial advisors, I can't tell you if it's a good idea to pay into your pension in general. I can tell you it's a good idea from a tax point of view, but you might need to seek financial advice if you really understand that. Do you want to lock your money away until you're 55 or whatever the case may be? So have a look at those things. And then the third most important thing, which is kind of going to be one of the most obvious and where we get really involved in the subject of many a podcast, and that's claim all of your business expenses. Get your knowledge up. Make sure you think about what you can claim. And you're doing that, excuse me, by listening to this, you're already on that journey. But you want to max out your legitimate expense claims. So, and think about things like my home office. Think about, there's a recent podcast I did on 5 limited company tax secrets, some of these weird ones you might not know about. Think about all those kind of rules. How do I claim my travel? What can I do with meals, travel, entertainment, all those kind of things. And we've done loads of podcasts on those, loads of videos, loads of blogs. So wherever you are, you will be able to get an absolute ton of information. I was looking the other day, I think there's something like 320 odd videos on the main YouTube channel. There's probably a similar amount of blogs, probably 200 odd blogs over these things at HeelanAssociates.co.uk. So check those out. But I'd be looking at claiming the business expenses. And on top of that, probably the most important tax tip, for those of you who've listened for a while, you'll know this, keep good records. And that starts now. So if you've never been in software, I would absolutely get yourself in some software. I mean, as a limited company, I would find it, I'll be amazed if you're not in software or you're working with an accountant that, I don't know, hates himself or something. Like it's horrid if somebody is not in a piece of accounting software as a limited company. But if you're not, make sure you get your records done. And I would really encourage you to keep them up to date regularly. If any of you follow me on Instagram, you'll see quite frequently I post a story up there every morning. I check some of the key numbers. I've got a dashboard. I'll check them. I want to see where I am with the business goals, how we're doing, and everything else. And I want that for you. So that starts with good current updated records. So make that a 2025/26 goal. I mean, I actually set a lot of goals based on tax year because I'm an accountant and I'm sad, but I'd encourage you to do that as well if you want. So go and have a look, but claiming all your business expenses is obviously going to be key. Then I'll be looking at annual investment allowance and the big stuff. So if you're thinking of making any big purchases, quite often if you're buying like a new, I don't know if you can see it on camera or you clearly won't hear it in the podcast, but I'm sitting on a MacBook. This was a pre-year end. I've finally updated probably the most awesome piece of technology I ever bought for the business was a MacBook that's lasted me 10 years. And the one before that lasted me about 9 years. They really have stood the test of business time. And the only reason I upgraded is I just needed more space and more capacity. But I did that before our company year end because I want to claim and reduce the next tax bill. But again, for many of you, you want to plan these expenses. I know we do. We always plan these expenses and think, okay, when are we going to need them? Make sure we capture them in the company year end. So at the beginning of the year, it's a good time to start thinking about it. And the reason that these big purchases are quite good, like a laptop, is because you can quite often claim annual investment allowance, which is basically 100% tax relief. So let's say the MacBook's $2,000, that's going to reduce your profits by the full $2,000, even though that MacBook is going to carry on over years for you. And you're going to be able to reduce that next bill. Really, really big. But the annual investment allowance, we're talking about $2,000. You could have like hundreds of thousands of pounds worth of machinery that might count for the same relief. It's the same relief. So whatever you're doing, plan it up front and think about it. And again, company year end. So again, your company year end might be the 30th of April. So we're talking about new personal tax year, but your new company year might be now. So bear that in mind. Then we're going to go into as a limited company owner, something known as trivial benefits. It's a very minor thing, but it's a weird rule. We've talked about it a lot on podcasts, blogs, videos, but it allows you as the director to buy up to effectively £300 a year in £50 instances. Again, I don't want to go too deep into it in one podcast, but it's there for random gifts. It's designed so I can give one of my team a birthday present and the company can gain a tax deduction on it. They don't get personally taxed on it. So that's absolutely what we want to be doing here for you as a director. So if you're thinking, actually, yeah, that would be quite good, that you can claim an extra £50 there. They're minor, but it does add up over the years. Because if you think about it, if you didn't use that rule, that £50 piece of personal expenditure that could have been a gift, could have been a trivial benefit, has to be, you've paid corporation tax on it up to 25%, then you've paid dividend tax on it at somewhere between 8.75 and, upwards of 34%. So, ish, we're using round numbers in this podcast. So it really is important. So have a look at that. Trivial benefits. Just stick it in. We've got a podcast on it. We've got blogs, videos. And then the sixth thing I would want you to look at as a limited company owner is your VAT status. So if you're not VAT registered, say you're new, I think you'll want to have a look and decide if voluntary registration's for you. So you can, for most businesses, not all of them, you can choose to voluntarily register. And you can also choose potentially to join something known as the flat rate scheme, for example. Now, there's not many businesses that do that now. Actually, it used to be the thing everybody did because it saved a lot of money. And I won't, again, go too deep into it. But the way the scheme works is you apply a flat percentage to the money that comes in and hand that over, rather than having to figure out, okay, I've got to work out every single small receipt of everything that I'm claiming, and I've got to work out what the VAT rate is and everything I'm selling and offset one against the other, report this in detail. Flat rate scheme cuts all that out. It's a simplified record keeping idea. But for a lot of businesses now, it just doesn't make financial sense. But the practicalities of it make it attractive. But in some instances, it still can be a win. So think about that. And think about whether VAT registration in general for you is good, particularly in the early stages. And if, again, there's other podcasts and blogs and videos on this. But also, if it's sad and your income has dropped below the deregistration threshold, which at the time of recording the podcast is about 88,000, then you've got to consider, is it still beneficial for me to be VAT registered at all? Because particularly if you're direct to consumer, you might find that it isn't actually, and you're losing money by still being VAT registered. You might be able to be more competitive and potentially retain more money. And there are these businesses that kind of bounce around this level that really don't want to be VAT registered. So have a look at that and think about it. And that could be a win either side. That one, again, it needs a good bit of maths done to it in a spreadsheet to make sure. And then a couple of ad hoc ones, I would say. One is electric car. So if electric cars are still good, we've seen that double cab pickups, which are like what I call monster trucks, big trucks with all the seats in them, crew cabs is the term used to kind of in the industry. They've got really bad treatment now from April. So you're probably going to skip over those if you're looking at doing that into the limited company. You probably want to lose the seats and look at a normal one, because the other one, the normal kind of non-crew cab ones, are still pretty good for the right ones. They still can't count as vans, but otherwise, the crew cab ones are going to end up counting as cars for tax purposes, and that's going to be a real problem for you. So I would steer away from those, where normally we would talk about those being a benefit, but electric cars are still good. You're still going to pay something known as benefit in kind. So that's tax you personally on having the car provided to you to use personally and available to you use personally. And the company's still going to pay a bill of 15% on that provision, but the bill itself is quite low. The figure it's calculated on is quite low. The benefit in kind itself as a percentage, that's how they're worked out, is quite low. It still goes up and it still creeps up, and you've got to think about the long term. But again, if you need a vehicle, that's probably the only one you're going to look at in your limited company and think, seriously, this is tax efficient. So have a look at that. And then finally, I'd say if you're thinking of selling your business, you're going to want to plan around something known as business asset disposal relief, what used to be called entrepreneurs relief. And that's had some changes from April. But if you structure it right, you could still potentially sell your business, and the money that you get from it, if you structured it right, and if you could claim this relief, is only going to be taxed at 14%. And quite frequently, I speak to owners who are selling their business, and they've all got, I'm going to pay 40% in their mind. I don't know why they pull this figure out. And I do know why. For a lot of people, it's that higher rate of tax. But it's always funny because there is another rate of tax above that. And nobody ever thinks of that one. They always just think of the 40%, but they think, look, I've written 40% off in my head, but it could be 14% if it's structured right. Now, in order to kind of cover most scenarios, you actually want to look at this 2 years ahead. There's various criteria, and the 2 years is important, but for a lot of people, that's not normally in play. Normally they want to sell it in like 6 weeks or whatever, and there's some deal that's come across the table, but ultimately try and plan as far in advance as you can, which is why I mention it now at the start of the tax year, because it's the best time to start thinking about it, particularly if you're going to do it in the next 2 years, because you want to structure that right. Now, the only thing I would say about that, I think we've talked about it in another episode, is that the tax rate goes up in April 26 to 18%. So if you want the best with bunny ears tax relief, you want to do it before next April. So you'll be within that 2 year window, which might limit some savings depending on what we're looking to do, and depending if you could qualify at all. But if you did qualify, it's definitely still the cheaper way to do it, because if it's going to be 4% more expensive the other side of April, and however long you think the deal's going to take, add another 3-4 months on it, for sure, because everybody thinks they're going to get it done in 3 months, and it very, very rarely ever is. So there we go. So they're kind of the 8 main points, I would say, for limited company owners. And then we move down to sole traders and partnership. And the number one, when we get to this one, some of these cross, as I say. So the first one is to claim all the expenses, to keep good records again. Now, big thing, many sole traders aren't in software at the moment. And the reason not is because they don't need to be a lot of the time. A spreadsheet's fine. For many people preparing their accounts on what's known as the cash basis, and we'll talk about that in a minute, they just need a list of income and expenditure, what went in, what went out for tax purposes, and they're sticking that in their tax return in 2 boxes. That's fine, right? That's it. But from April 2026, if your income is over £50,000, you're going to be taken into what's known as making tax digital, which means you're going to have to submit quarterly income returns, basically. It's a bit like what VAT returns are right now. You're going to go and submit them. I mean, flippantly, we're calling them 4 extra tax returns, but they're not full tax returns. But it's the same idea. You need to fill in those couple of boxes, really, in a digital return. And there's no free software for this, so it's got to be in some sort of software. There's no market controls on this. The government are letting them go loose, so you do need to kind of pick a software. Now, undoubtedly, we're going to be doing a lot of content on making tax digital, because it's the biggest shift in sole trader kind of tax and reporting that I've seen in the 18 years of doing it. And I'm probably ever anyone's seen since the introduction of self-assessment, which I think was in the 90s. I know there's accountants that listen to this one and will be screaming it at the earphones right now, but since then, so it's going to be big. So my tip here is, yes, get knowledge, do what you're doing, listen to the podcast, watch videos, read blogs, but and understand what you can claim. Make sure you get all that in, thinking of travel, cars, use of home, professional fees, how clothing works, what you do with entertainment, if you do anything at all, how does stage costume work, all these kind of things. If you're an influencer, there's a ton of things that we could talk about in terms of, can I include that, can I not? All these things, educate yourself on and get those right. But ultimately, I think your biggest action point here will be get yourself in digital records. Now, currently my go-to would be Xero, because I think they're the market leader and I love what the company do. That said, I think you could also look at other products. There's a lot of good stuff coming out. We're certainly looking at all angles at the moment. But if you did want to get yourself into a full Xero kind of journey, if you go to heelanassociates.co.uk/Xero, there's a discounted Xero deal on there that can get you on that journey. So go and do that and get yourself off to a good start. But yeah, keeping those records digitally, absolute A1 priority for you as a sole trader this year. Then we're looking at pension contributions again for the same reasons. Now, again, we're talking with pensions for sole traders. We're talking tax year to tax year. So we're not looking at doing anything in any other funky times. You've got till the 5th of April 26th to deal with this, but helping pay into a pension. Firstly, you planning how much you want to pay into it is good to think about that at the beginning of the year and getting a bit of a time horizon on it. Now, the chances of it affecting your tax bill as a sole trader, I would say, are rare unless you're a higher rate taxpayer. So if you presuming all of your income combined is going to be over about 50 odd grand, then it starts to really impact it on a practical level. But either way, pensions and thinking about that can be done early and given some thought to. Then we're looking at, we mentioned cash basis. So particularly if you're new to sole traderness, I don't know if that's a word, probably not, you can pick 2 bases of which you fill your tax return out. The cash basis, which is now the default, and that's all you do is you add in literally what money come in, what money went out based on dates, and that's what you're going to base all your figures on. The more standard version, the accruals version, as we would call it in the accounting world, is about dates. So, if you've invoiced work on the 5th of April, but you haven't been paid for it, you would still include that in your records. Where in the cash basis, you wouldn't. You'd only include what you've been paid for. And sometimes that cash basis can actually save you some money because you might have had an invoice that was quite big that could have taken you into the higher rate of tax, that because you're in the cash basis, you won't actually include until the following year. And maybe your business dropped lower the next year, or you're expecting it to because it's a one-off bill. I don't know. There's loads of scenarios. But thinking about the cash basis is often good, and the record keeping on it is easy. So actually from a reporting basis, it's good. And I think it's one of the reasons that the revenue made it the default is because that's how most people practically thought about it. What have I add in? Get the bank statements. Works really well with record keeping digitally as well, because say you get yourself a Xero license, you can connect and I'll get a proper account that's not your personal one with all your personal expenditure in. Otherwise, this is going to be a really painful process. But you can connect that fresh bank account to your Xero, and every day you're just going in and categorizing what's coming out. And you can set rules and all this kind of stuff, and it's really, really good. If you want a practical guide on how to do that, actually, and see the main features in play, if you go to our main YouTube channel at Heelan Associates, you'll see there's a Xero Basics guide there, and it runs you through the 5-6 main features that would be really, really good to use. So, but getting in there will help you with this cash basis. And sometimes the cash basis is the other way around. You might not want to be on a cash basis. You might want to be on an accrual basis because it has a better reflection of your actual profits and income. And as accountants, we love the accrual basis, but I reckon if you looked at the tax returns we prepare, and we prepare hundreds and hundreds of them, we will probably see 60%, I would have said, maybe at cash basis because of the record keeping and the way it's done, maybe more now. So bear that in mind. But yeah, cash basis. Just a caveat on that, if you have listened from the beginning, if you're a limited company, you don't have this choice. It's one of the benefits of being a sole trader is you can pick these cool things. And now they've done a lot of changes in the last couple of years to make cash basis even cooler from a tax perspective. I get quite excited about it. Previously, you kind of didn't want to touch it because there were several things you couldn't do with like losses and certain amount of interest and things you couldn't claim. It's all sort of gone out the window. It's now very similar basis. Really, really cool. So consider that. Now, you might also want to have a look at, is there any, and this actually applies to the limited company as well, which is why I said some of the tips cross. But if you've got a family member that genuinely you want to employ and put them into the books, it might be worth you thinking about a payroll for this year to pay them some money. Okay, there's a bit of money to be paid in terms of, or hassle, depending on which way you do it. You can either run the payroll yourself, you can outsource the payroll, but paying them some money could actually lead to some tax savings and help that. So say you've got a significant other at home, maybe they're primary child carer, but they're helping you with admin or marketing or social media scheduling, paying them a small wage through a payroll could get you a tax deduction and help use some of their unused allowances potentially. So you could call it profit sharing because that's ultimately what's happening, but you've got to be, for it to actually work, they've got to be commercially employed and doing the right things, and it makes sense. You can't pay them $100,000 a year for doing an hour a week or something. Well, you could, but I think the revenue might say it's not wholly and exclusively for your business at that point. So just be careful about what you're doing. But genuinely, that is possible to help spread that. And in a limited company, you can do the same thing. You can also do it with shareholding and things like that. You've also got the option for annual investment allowance. So think about those bigger purchases. Again, really, really good. But if you're on the cash basis, you don't use the annual investment allowance, but it's the same effect. So you put it in your expense boxes and get full relief in one go. So still really, really good. If you've got any losses, you can start thinking about those as well. That might affect some decisions. I won't go into too much detail there because it's quite niche, but you can start thinking about those losses and think, is there anything else I can do with those? They're particularly useful if you've got a sole trade loss and you've got another job that you're paying tax in. You can do some cool stuff there, potentially get a tax rebate. So things to think about. Just as well, just check your national insurance. Most of the time this is going to be sorted out on a tax return, but whatever your various different sources are, make sure you've got 6.5K-ish in one of your jobs. I think that's quite important. And then we did mention VAT previously. I think it's definitely worth having a look at your VAT position and thinking, is it a good idea for me to be VAT registered or not? If I've got a choice because I'm under 90,000 threshold, is it worth the hassle? But I've just told you that you're going in software. So if you're already in software on that journey, it's less of a hassle than it would be otherwise. Because if you're in the VAT world, you have to be in software now for something called Making Tax Digital for VAT. And they do exactly the same thing. They have to submit digital VAT returns. So if you're already in there, you might think, actually, if it's beneficial for me, say you're business to business and you're only working with VAT registered businesses, that might be a good shout. Again, depends on your situation, how much hassle you want with the paperwork side, but it's very, very possible. So think about that. And again, if you are VAT registered, and you don't see too many VAT registered sole traders these days, a lot of them end up in limited companies for other reasons. But if you are, and you have gone below that deregistration threshold, you can review it there. Same we said about the limited, thinking about that flat rate scheme. In terms of everybody, I think if you just look at the various allowances. So we've talked about using salary in the limited company. For everybody else, it's just making sure that actually you've got this 12.5 grand a year personal allowance. Just make sure you're using it somewhere, earn enough money to use it. I know it sounds silly because it's more of a result than it is anything else. But with a limited company particularly, you can almost choose whether you end up using that or not. And it's a use it or lose it allowance, your personal allowance. And the amount of small startups we see that just miss the opportunity to have declared themselves for salary to use it up, or they've got a significant other, like we said, that they could employ, whether you're sole trade or limited, that could use theirs up by having them on the payroll. These things really make a difference. So, and you want to do that as early as you can in the tax year. So have a look at that. And it's boring, but I have to mention it because it's tax, but ISA allowances, £20,000 a year, you can invest tax-free into your ISA. You might want to think about when you want to do that. Again, you got ages, but I always find talking about it early means you can plan, because otherwise you get to April, and I'd always do these kind of podcasts where I'm like, your last minute tax saving tips, but not many people have just got 20 grand sitting around to deposit in something. But you might, during the year, have a really good trading year. Maybe you want to put some stuff aside. So think about that. We already spoke about pension contributions. Regardless of where you are, you'd want to have a look about potentially boosting that. And if you're a higher rate taxpayer, you're going to see a positive effect on your tax bill. Or if you're nearing that higher rate tax and you might exceed it, it's a good one. I see a lot of people who earn, say, 49 grand, and then they're going to get a 5 grand bonus that might take them over into the higher rate. And actually, there's quite a bit of scope for making a pension contribution and bringing that 5 grand, because of the way it works, you kind of bring it back under, you extend your band. So it means you can earn more than 50k and still pay the lower rates of tax. It's quite clever the way it works. So have a look at that. And then if you're going to give money to charity, there's always something known as gift aid. So keep the paperwork, declare that on your tax return. And if you're in a weird situation where you're under the higher rate, so you're a basic rate taxpayer, and you can't do any of these employing you're a significant other or anything else. But let's say you're married, because it's marriage transfer, so you have to be married or civil partnership, and you've got unused allowances. You can actually make a marriage allowance transfer to transfer some of their allowances to you, or vice versa, depending on your situation. So just have a think about that. Again, maybe that's a bit more of a deep dive into it, but just Google marriage transfer, marriage allowance, and you can see there's a few options. It's really simple to do, but it's kind of an all or nothing relief. So there can be some downsides to it, but yeah, it doesn't work. It doesn't work if one of you is in the higher rate, because everybody would do it. It'd be the most obvious tax plan ever. So have a look at that. And they're kind of the main tips, I would say, to start you off in the most tax efficient way. So there's quite a few things there to go deep into. I mean, we've done this in a 25 odd minute podcast. It's actually longer than I thought it would be. I thought it might only be a 10-minute chat, but anyway, get me going on tax and we'll be here all day. But have a look at that and just start to deep dive into some of those points. And all of these things we've done other podcasts on, I definitely will be doing more as the year goes on around. Obviously, we always talk about business expenses and all the different types of things like that. And salary will be up there. Dividend splits will be up there for limited companies. And we will be most likely talking about sole trader expenses again. I think we're due to do another basic show on some of the key elements and things and kind of concepts, I suppose, with sole traders that would be good to recap on. And this cash basis, I think, is always a good one to visit. So there will be these other things, but you can go deep dive in them right now. So hopefully you've enjoyed this show. If you have, please do make sure to subscribe via your favorite app, wherever you get this. I know many of you and most of you get it from Spotify, but go on there, subscribe if you get a chance. And I know loads of you have. Thank you very much of those of you that have given a few reviews. And there's actually a new place you can do comments and stuff. Didn't know this until recently. So if you get 5 minutes, stick a few thoughts on there. Love reading those. You can also subscribe to our YouTube channel. We've started up a separate one just for the podcast, so I can basically ramble at camera without too much editing. And it goes up on there so you can see it pseudo live. Maybe we'll do it live one day. Maybe that's the plan. Maybe that is a plan when we get the tech sorted. But at the minute, you can see it up there. And it's a great way to interact with us because there's comments there. We find on our main YouTube channel, we have chats all the time with people. So it'd be cool down below in this one to have any chats with anybody that wants to ask questions and things. Can't give direct one-to-one advice because of the way the regulations work, but I can normally point you to the right thing that'll get you the answer or give you some generic thoughts. So please do interact with us there. For more business insight and tax tips, be sure to connect with me and all of my great team on all the social media channels, including, of course, LinkedIn, Insta, YouTube, TikTok, Twitter, Facebook, pretty much everything past Snapchat. We're not there. We're not that cool. You can sign up to our 2-weekly HeelanHub Herald, which contains even more business insight and tax tips. You can do that on our website at HeelanAssociates.co.uk. Scroll around long enough, you'll see a pop-up. Stick it in there. We don't sell your information. It's purely to send you interesting information. And as I mentioned earlier, if you do want to pick up a Xero license, currently you can do that at HeelanAssociates.co.uk/Xero. Get yourself into the world of accounting software with an awesome piece of cool software at a discount. And of course, if you want to get in touch about the podcast generally outside of any of those means we've just said on socials, you can do so by emailing us at info@heelandassociates.co.uk. That's it. Have a profitable and tax efficient week, and I'll see you in the next one.